Okay, yeah. Today's lecture, super ambitious. We're trying to cover literally what takes a couple months to actually understand in just a couple hours. So our goal is conceptual understanding. We don't expect you to memorize all the formulas we go over today, but what we found as a big gap was that the lectures, the PDFs that you can find online that try to explain these topics, they don't explain the intuition behind it, which we think is one of the most important things. You will need to know everything we talked about today for technical interviews. So whatever you really don't know anything about, make a note of it and start studying it. We didn't do anything that's like super extra or extraneous. And I'd say if there's a day to lock in, it's probably today. I'd say shut your computers, focus on what we're saying, pay attention, and the pizza is there to kind of incentivize that. Feel free to grab any of them. Okay. Last week we got feedback. Define the terms. Tell us what you guys are talking about. And like we said last week, this is a lot of content that we're going to throw at you. If you stay the course and stay the 7 weeks, you will understand everything that we have. In addition to that, ask us questions. We don't know what you guys know. So when we say something that you don't know, please tell us and we're more than happy to explain that kind of stuff. Okay, I'm going to get straight into it. Are there any initial questions? Any feedback from last week that you want us to say again? Okay, if I ask what's the difference between a bulge bracket and a elite boutique investment bank, you can tell me the answer. Okay, yeah.
A bulge bracket is like the biggest banks that we've all heard of, like Goldman Sachs, Morgan Stanley, and they like global scope in dealing with pretty much anything an investment bank could possibly deal in. And then elite boutiques are still very prestigious places to look at, like Lazard, Centerview, but they're more smaller and specialized.
Yep, great answer. If I ask what's the difference between a hedge fund and a private equity firm, what would you guys say? Come on, you guys have to remember this from last week. I see new faces, so I'm not going to call on you guys, but I see some old faces.
Yeah, well, probably is software.
Perfect. Yeah. Okay. So again, pay attention today because next week we don't have a meeting next week, but when we come back after fall break and I ask you guys what is the EBITDA, I expect every hand in the room to go up and tell me what the EBITDA is. Okay. First concept we need to go over is time value of money. So if I ask you, would you rather have $100 today or in a year from now? Let's just do a survey. Raise your hand if you'd rather have that $100 today. Okay, and raise your hand if you'd rather have it in a year from now. Okay, so investors and finance people would love you because you would just make them infinite money. But pretty much the correct answer, I guess, not to say you're wrong, Charlie, but the correct answer is that you would much rather have $100 today. If I asked this question in 1975 and give you a 40-year time frame, that $100 would be able to buy you 50 movie tickets, whereas in 2015, much less than that. And the way we measure this is through something called the Consumer Price Index. And this is something that the Federal Reserve kind of maintains. The economists always look at these numbers. It's indexed to, I think, 1980 to be at $100, but it's pretty much the measure of a core basket of goods and how much that cost changes over time. So why are these goods changing over time? Are goods just that much better today? Are people just making more money? Answers to both of those questions are probably yes. But the two main reasons are so the way we measure the thing called the price index, you can see it's around 3.17% per annum compounded growth. And target the big factor in this life. We can 0%. Second thing, I give you $100 today. That means that this $100 today is actually worth $108 a year from now because it's properly and a risk-free investment. Risk-free investments can yield about 5%. So at least you should be discounting it for that. So how do you value a $100? I tell you, 5 years from now, how do you discount that back to the present? You use the same discount rate, and have that R down there, and that's usually measured in years. So, for example, if you're using a 5% discount rate over 5 years, you would take 10 to be 5 and R to be 5%, and 5 years. Something you will learn in all of your economics classes, and this is pretty important. Yeah. Yeah, so of course you're today the discount rate is 5%, 3 years from now the discount rate is 7%. This is a very simple way of looking at it. Of course there's so you can imagine this is like an annual discount, right? If you do semi-annual, you would divide R over 2 and multiply by 2. Now instead of every year you get 5%, every half year you get 2.5%, it changes the constant. If you take that limit, you take that limit as the 2 becomes a 4, becomes an 8, becomes infinity, you actually get the E. So E Euler's number, 2.718, whatever, that is the E compounding. So in the last equation, if you look at so this number is unmet property, but that's again not something you really need to know. Okay, I'm gonna move on because you really go a lot. The second thing is that so on an accrual basis, revenues are recognized when earned and expenses are recognized when incurred. You guys can apply that. Cash basis revenues are recognized when cash is received and expenses are recorded when cash is received. So for example, Apple makes an iPhone in 2020 for $100. They haven't sold that iPhone until 2022, where you buy it for $150. Under cash accounting, Apple's profit and loss in 2020 would be negative. In 2022, the profit and loss would be plus 150. Obviously, this isn't a full picture, right? Because they really, under accrual accounting, you would do something different. In 2022, you would book a profit of 150 and a cost of 100 because you incurred that expense when you sold it. So this is a little bit nuanced. Reporting is done in, and this is a couple of consequences. The main one being the account table. But you're good. Now I still book that revenue. And it buys an iPhone from me and says, "Oh, I'll just give you a check a year from now." I book $100 of revenue today, book the expenses that I want to make that iPhone, even if I don't receive that iPhone or I don't receive the money from that until a year. So this kind of again. Yeah, all income statement, all balance. Oh, sorry. Yeah, this is on the income statement. It's all accrual. Any other questions? Sorry, I know it'll hopefully make a lot more sense once we get to the I think that's the best example. Okay, so depreciation and amortization. Let's say you are your Toyota. You want is buy for $10 and you try and resell it, you're not going to get $10 from it. Then that's true for the vast majority of goods. For example, cars. Of course, there's appreciating assets like really expensive cars, real estate, for example. But for the most part, these are all depreciating assets. So amortization is the same thing, the same idea, but for intangible assets. So if you spend $1,000 to buy a patent, and that patent has a useful life of 20 years, you wouldn't be booking $1,000 in year one and zero for the 19 years after that. You'd be doing 1,000 over 20 for the entire useful life of the asset. So in accrual accounting, again, going back to the example of the machine, if a machine costs $10,000 and it's used over 10 years, you record $1,000 as an expense every year under the line item depreciation and amortization, even though you paid the full $10,000 up front. And this is where you need those three statements that we're about to go over to kind of give you the holistic picture of a company. So again, if a company buys a truck in 2020 for $100,000, it used that truck for 20 years. Under cash accounting, it would have minus $100,000 in 2020, but under accrual, it would have minus $5,000 per year as the useful life of the truck gets worn off. So there's a caveat to this, which is we're all working with linear depreciation curves, simple depreciation. There's a ton of different ways to depreciate an asset. You can imagine that when you drive a car off the lot, you lose 50% of the value instantly, and then slowly it tapers off, right? So this is really an accounting trick, and it's actually kind of nefarious because you can use it to hide a lot of stuff. So Waste Management, a huge company, they pick up pretty much all of our trash. They had some gimmick with the depreciation of their garbage collecting trucks. And it was like a huge scandal, cost them $1.8 billion, tons of SEC fines, like management turnover, a whole bunch of stuff. So as a savvy investor, unfortunately, even though it's annoying to think about, you do have to truly understand this stuff. And it is something that will come up in all of your interviews. Okay, a lot of stuff I just threw at you. Any questions? Yes?
How do you predict when you use a truck or something? So if you use it for 30, but you use it.
It's every asset has a useful life, and typically they'll have a salvage value at the end of it. I don't know exactly the accounting fundamentals that go into that. There are two types of accounting that I want to just note really quick. Financial accounting, which is what we're talking about, which is you're not actually owning the business, but you're looking as an investor to try and invest in the business. What you're talking about would be more of a managerial accounting. So if you actually run Toyota, you make your books, you do all this analysis on a per asset level. That is the person who would be answering that question. Like, what if we get an extra year out of this asset?
Yeah, just to jump into your question real quick. So let's say your truck is 2,000 and you do 10 years on the assumption that it's a 20-year useful life. So you've depreciated 1,000 of the 2,000. And then at year 10, you think, oh, wait, no, instead of 10 years, instead of lasting for 20 years, I think it's going to last another 10 years on top of that. So 20 years. What you just do is you take this remaining value that you have not depreciated, 1,000, and then just divide that by how much longer you think. In this case, 20 years, and then you just depreciate that every year. Yeah.
Any other questions? Okay. Again, we're going to have a much more complete discussion on macroeconomics, central bank policy, inflation, interest rates, all of that stuff in a future lecture. That's out of the scope of today's technical crash course. Okay, moving on to accounting.
So we know this can be quite dull, just bear with us. This is corporate lingo 101, commit this to memory, and you never have to do this again. When you look at a company, you're really looking at three different statements: income statement, balance sheet, and cash flow statement. This tells you a lot about the health of a company. When people talk about fundamental analysis, they're looking at these three statements, okay? We're gonna go through them very quickly. So first, income statement. It flows from the top to the bottom, so from revenue to net income. We'll go through each line item one by one. So on the right, you see the actual income statement from Apple in 2023. What is revenue? Well, think of it as quantity times price. How many iPhones they sold in a year, what each iPhone cost. And then from revenue, you subtract COGS, which stands for cost of goods sold. So this is all the raw materials that go into an iPhone, how much they cost. The aluminum, the workers in India and Taiwan, right? So after this, you get gross profit, which is the useful metric to evaluate how profitable the business is on one level. And then you have to pay for all the scientists doing the research and development, right? So R&D, you take away that. And then you take away the sales, general, administrative. What are these things? So think of advertising budgets. The fat bonuses for Tim Cook, they also cost money. And then it's D&A, depreciation, amortization, which is baked into it. It's implicit, it's everywhere. It's part of the cost of running a business, a part of its operating costs. A lot of companies don't report this explicitly, but you should keep this on the back of your mind. It is an important cost factor. This gets us to operating income, also known as EBIT or EBIT. And from this, you take away the corporate tax rate, and then you get net income, which is how much profit the company made in the year. Does that make sense to everyone?
Any questions? EBIT, by the way, stands for earnings before interest and taxes. And EBITDA, if you just add back D&A, that's how you get earnings before interest, taxes, depreciation, and amortization. It's actually not a US GAAP financial metric, so it won't be reported on financial statements, but it is something that a lot of investors will look at, and we'll go into the reasons why. Are there any other questions on any of these terms?
We're good?
Okay.
And you can always refer back to the skeleton framework that we have. So that's one, so now we have some important ratios to look at. So gross profit margin, operating margin, and net profit margin. Why do you care about these things? Well, they tell you a lot about the company's profitability. On one hand, look, we have Apple and Sony, right? On the surface of things, their gross profit margins are somewhat similar. They both sell consumer electronics to a lot of different clients. But which one's a better company? Well, if you look at the operating margin and ultimately the net income margin, the story is very different. Apple is significantly higher than Sony. And from this, you can infer a lot about their business model. For instance, Apple has pricing power and Sony doesn't necessarily. And Sony also has basically the operating divisions are very high capex spending. So again, that's why we care about the income statement. But the major caveat here is paper revenue does not equal cash. Your business could generate a lot of revenue, but if you have high costs, you won't even have a positive net income. And also because we're in an accrual-based accounting system, just having revenue doesn't mean you have cash in the bank, right? Say could have promised to pay me or bought something from me right now in the present, I'll book that as revenue, but he may not pay me until 2 quarters later. So and the famous example of this will be WeWork that went bankrupt, I think 2 years ago. They had crazy high revenue, but zero cash. They're losing a lot of cash every year. So if you're, in case you're wondering, how could a business generating so much revenue end up in bankruptcy? This is how. And then we move on to the balance sheet. Again, a lot of line items here, but think of it as 2 distinct portions. On one hand, the left-hand side, you have assets. On the right-hand side, you have liabilities plus shareholders' equity. So what are assets? Well, a quick and easy definition is, a company's resources, what it owns. So this includes stuff like cash or inventories, accounts receivable. So, he promised to pay me for something. He hasn't paid yet, but I own, this promise that he keeps. And then prepaid expenses, pretty self-explanatory too. Let's say he's my supplier and then I already paid him for what he'll deliver to me next quarter. That is an asset that I own. Property, plant, equipment, pretty self-explanatory. And then, And so now we move on to.
I just want to quickly say
Yeah.
one thing here. PP&E or property, plant, and equipment is like any machinery, factories, buildings you own. That all would kind of fall under this property, plant, and equipment. And the easiest way, like the CFA has this definition and asset as a company's resources, but sometimes when you think about like, oh, it's accounts receivable versus accounts payable, it's deferred revenue versus prepaid expenses, are these assets or liabilities? The easiest way to think about it, in my view, is assets are anything that are going to generate future cash flows. So for example, accounts receivable, it's a promise that someone will pay you, that generates a future cash flow. Accounts payable, on the other hand, is something that limits a firm's future cash flows because it's money that they owe to someone else under a shorter time frame. So that is like the, I guess, headline on what is an asset versus liabilities.
Right. And if you look at the figure at the bottom, you add all these things up, you're at $350 million, or it's actually probably billions. Yep. And then on the other side of the equation, we have liabilities plus shareholders' equity. So this includes lines, obviously, like debt, deferred revenue, that could be short-term or long-term. Deferred revenue, which is, for instance, stuff that I've collected cash for, but stuff I haven't done. For instance, if he purchased a service from me, and it's a subscription service, he pays me at the beginning of every month, but may not have delivered a good or service to his it. And then accounts payable, it's the opposite of accounts receivable, and accrued expense, which is the opposite of prepaid expenses. And then that leaves us with shareholders' equity, which is what the equity investors own in the business, right? Think about all the stuff that's generating cash, all the stuff that's taking away cash. Whatever you have left is what the investors own. And the most important thing you need to know about balance sheet is the iron law. Assets equals liabilities plus shareholders' equity. It has to hold true, and that's the whole point of doing an accrual-based accounting system. And unsurprisingly, if you look at the figure at the bottom here, it's also 250 billion.
And so a lot of times, so again, I'd say in terms of what you need to know for your technical interviews is you should be able to say what line items fall under the income statement, what line items are in the asset section, liability, shareholders' equity, and know what each of them means. You should be able to tell the difference between accounts payable versus accrued expense versus deferred revenue. They're nuanced, but there are differences. And I'd say the last thing is whenever you get asked a technical question, which is like, how does $10 of depreciation flow through the three statements? Very, very common interview question. Whenever you get to the balance sheet section of answering that question, you should know that, okay, if I said my assets fell by 10% or $10, that liabilities and shareholders' equity must also fall by $10. Because those always are always equal. There's no like exception to that rule.
And that's like an example.
Yeah, we'll look at it very quickly.
And third, and arguably the most important statement you need to look at is the cash flow statement. We mentioned earlier how paper revenue doesn't equal actual cash. Remember, cash is king, and this is what you care about. Net income from the income statement is at the top here. And then from this, you add back depreciation and amortization because it's non-cash expense, right? I bought the factory in year one, but I'm not actually spending $20 million a year for the factory. I've already spent it all in the beginning. And then we move on to cash flow from operations. This includes stuff such as changes in net working capital or NWC. Think of it as all the cash that's tied up in the business operations. So your inventories, your short-term expenses, and all that. Why do we take away changes in net working capital? Think of it as if this term NWC increases, more cash is tied up in actually running the business. So it's not cash that I can actually use. And then we have cash flow from investing. So if I bought another plant for $1 billion, it's obviously going to dent my pockets, right? So you take away that. And then you have lastly cash flow from financing. If I raise more money, there's more cash into the business, and so on and so forth. And so at the end, you'll have a net change in cash, and then this will flow back to if you go back to the balance sheet, we'll go through an example.
Yeah, there's a graphic.
Yeah.
Really quick, we'll get here in a second, but we kind of burned through that, and that was intentional because there's stuff that we find more interesting than accounting that we think are more nuanced than accounting. But broadly, does everyone understand what we kind of just spoke about? Okay. If I asked you, or actually we have that already on the slides.
Okay.
Yeah, let's go back. Then I want to quickly explain the links. So you have to understand how those three statements link together. Common interview question is if you only had one cash flow or one statement that you would want. Like for a business, you can't have all three. Which one would you want? The answer is the cash flow statement. As George said, cash is king. In the case of WeWork, if you just have the income statement, you see this huge revenue number, but they're not actually getting any cash that hits their bank account. And the second question is if you had two statements, which two would you choose? And the answer is the income statement and the balance sheet, because with those two, you can reconstruct the cash flow statement entirely. And so the core links are that net income from the income statement will add into retained earnings on the balance sheet under the shareholders' equity section. And then that net income also flows to the top of the cash flow statement, as George mentioned. And to get from the balance sheet cash value, you take the end of the period cash flow statement total cash, and that kind of flows back up. So you start from the beginning, like on January 1st, what is our total cash amount? You do all the changes that happened in that time period, you get to the ending cash balance, and that goes back to the balance sheet. And the balance sheet is at a certain point in time. So it's like on December 31st, 2024, what does our balance sheet look like? Whereas the income statement and the cash flow statement are like over a period of time. So from January 1st to December 31st, how much income versus how much cash, or all those things did we earn / lose? So that's a slight nuance that is important, I think.
Right. We kind of skip this.
Let's do this really quick. Where does revenue belong on which statement? Yeah, exactly. Long-term debt. Yep. Which section of the balance sheet? Yep. Accounts payable.
Feel free to just shout it out.
Yeah. Which part of the balance sheet? Good. SG&A.
Yep.
Non-current assets. Yep. Current liabilities, I guess, is also liabilities, and DNA kind of exists on a lot of that. It's both on the income statement and the balance sheet through PP&E, and also on the cash flow statement, as we already talked about. Yeah.
Let's try something a little harder. This is a very typical interview question, so let's see if you can do it. If assumed tax rate is 20%, what will happen to the three statements if accrued expense goes up by, I think, 10 here? Any takers?
So again, accrued expense. You want to explain what accrued?
Yeah, so accrued expense, right, is stuff that actually has actual cost, but a cost that I haven't really paid for yet.
So do you guys think this would be good for your net income or bad for your net income? Yeah, we started.
Yeah.
Okay, yeah, so if you, like, you owe someone $10 and you haven't actually paid them, does this mean that in that, you have two cases, one case where you paid them when you bought the good and one case where you didn't pay them, which one would you have a higher net income in? Yeah, when you didn't pay them, right? So your net income, which is in this case, when your accrued expense goes up by $10, you owe someone $10 that you haven't actually paid them, your net income goes up by 10.
We'll go through it very quickly. So,
Yeah, sorry.
yeah, right, this is stuff, actual expense related to your business. And because we use an accrual-based accounting system, your operating expense will go up by 10. So consequently, your operating income, right, is gonna go down by 10. Now, pay attention to the tax rate. Tax rate is at 20%. So simultaneously, the amount of taxes you pay to Uncle Sam is also down by 2. So in net, your net income is only down by 8. This is net income, it's not cash. Remember, we haven't paid for this yet. So at the top again, this negative 8 goes to the top of the cash flow statement. Again, we haven't paid for this. So let's add 10 back, right, in cash flow under operations, and the net effect is +2. Now you'll see how the balance sheet reconciles these differences. So net income, the net change in cash is +2, right? But accrued expense has gone up by 10. So the balance of the two sides of the balance sheet, we need retained earnings to be down by 8, which is exactly what happened to net income. So again, you see this balancing mechanism in play again. Does that make sense?
And my mistake was accrued expense, again, all those nuances, I confused accrued expense with prepaid expense. Accrued expense, like he said, is a liability. Yeah, this is like a very common question. You should be able to work through a lot of these examples. Common ones are a $10 increase / decrease in depreciation, $10 increase / decrease in like paid in kind interest, all these kinds of things. And at the end of this presentation, we have a resources section where we give you the 400 questions for breaking into Wall Street that go over all of this kind of stuff.
But there's change.
Changes in net working capital. So if your inventory goes up by 10, NWC is going to go up by 10, right? So that's a +10 on the delta, but it's not good for your cash flow. It's more cash tied up in the business. Does that make sense? Yeah.
Okay, any other questions? Because we're gonna move on from accounting in a second.
Yeah.
Again, we know this is a ton that we threw at you. There's a really good video that we linked to that kind of covers all the stuff in a bit more detail and with more time than we have. And this is a guide or just we said a lot of words. If you ever get confused with R&D versus D&A versus SG&A versus DR versus AR, all that kind of stuff, it's all alphabet soup, but you should be able to tell the difference between them. And this is like a list of everything there. Okay. Okay, so corporate finance, central question is how do you maximize shareholder value? It's a big meme because that is like literally the central question. And this kind of gives you three main decisions that you have to make. First are investment decisions. Should I invest in this new product line? Should Meta launch their metaverse product or like Apple, their Apple Car? All these things are important investment decisions that the company from the operational side will make. The second is financing decisions. Should I raise debt? Should I raise equity? Should I issue more shares? Should I issue more bonds? Should I take out a bank loan? All these kind of questions. And the third is dividend policy. How do you actually return money to shareholders? Because a common misconception is, you know, if I buy into a company and the share price goes up, that's the company giving me money, which is actually not. The company can only give you money through two main ways, dividends or buybacks. And again, we'll cover all this in a future lecture in more detail. But the core one that we're going to be talking about today are financing decisions, because this is something that as an investor, you really do have to understand pretty well. So corporate capital structure 101. There's debt and there's equity, and debt can be broken down into secured debt, which is at the top. So let's say you have a company that's worth $100 and there's $20 in each of these bits. If your company is no longer worth $100, you go to bankruptcy court, they find that it's only worth $50. The dollar of first loss always goes to common equity. And then after common equity is evaporated at $20, then preferred equity starts taking the hit. So preferred equity will take the next $20 of hit, and then subordinated debt will take the $10 of hit, and your secured debt, your bank loans, are untouched, right? They still get their money back in entirety. And so the debt payoff structure, you can see the maximum value that you can make is whatever the interest rate is. So if you give a $100 loan with 5% interest rate over 1 year, the max amount that you can make is $105, right? They pay back the interest and the entire principal amount, but the max amount that you can lose is if the company suddenly is worth $0, you gave a loan to something that doesn't have any value, and it's worth $0, you can lose that initial capital. On the other hand, equity, again, similar, the most that you can lose is however much money you put into the company, but on the contrary, you have unlimited upside. So if you bought the company at $100 and the company goes to be worth $200, you're able to retain all of those $100 of earnings, whereas the debt holders don't get as much. And that's why the debt holders get lower return, but they have much less risk. And the equity holders get a lot higher return, but they have much higher risk, right? Because it's tied to the entire company. So these are referred to as the cost of equity and the cost of debt. And again, we'll go into what this means. But the central question of corporate finance, I guess, is what is this optimal point for any one company? And a lot of factors kind of determine this. The cost of debt doesn't always look like that. It depends on the rating of the company, how many assets are there, if it's collateralized loan, like all these different factors. But generally, this is what the WACC, weighted average cost of capital, WACC graph would look like. And you're trying to answer this question of how much debt do we raise versus how much equity. So formulas, again, you should memorize this in your own time, but it's exactly what it sounds like, a weighted average. You take the cost of debt times the percent of debt, the cost of equity times the percent of equity. And the cost of equity, which is actually a really hard number to calculate, can be approximated with this formula. And I think in the next slide, yeah. So the risk-free rate is generally how much money you can get just by investing in that whatever country's government's bonds. So generally the US 10-year bond is considered risk-free because the US government does it so great, Uncle Sam will never default on his debt or her debt, his debt. Beta is the correlation with the general market. So how much does this investment move with the market? You can have negative beta. So for example, if the stock market goes up by $1, your stock will go down by $1, and beta can take like any range of values. So for example, beta is 5, the stock market moves up $1, your stock moves up $5. Equity risk premium is the additional return. So again, as equity is more risky, equity investors demand an additional return on top of the debt, right? So you can calculate this by the expected return of the stock market over the risk-free rate. So generally, let's say the stock market returns 8%, US bonds are at 5%, the equity risk premium is 3%. And that's coming from the equity investors needing to be compensated for taking on this extra risk. You can't read this table that well, but essentially this is the cost of capital by industry. Again, you should calculate this, and you can find this number on Bloomberg for any one specific company, but industry-wide, you can kind of see, for example, green and renewable energy has a lower cost of capital than building materials, probably because of government subsidies or something that artificially makes that lower. But generally, WACCs will stay within a certain range. And this is available. There's a professor at NYU. I linked his channel at the end. He does a lot of stuff on valuation and computes all these metrics himself. And he has a lot of good information on exactly what each of those terms means. Okay. Second thing, the Modigliani-Miller theorem. You don't need to know exactly what the theorem is about, but essentially, any company at the end of the day, and we'll go over this in a bit, can be broken down into certain cash flows. The company gives me $1 tomorrow, $20 the next day, $100 in a year from now. And you can, as we had already mentioned, discount those cash flows back to the present value. So when you do that and you sum up all these future cash flows, that is the firm's present value today. And the firm's financial policy or the financing decisions that they make divide that pie into debt and equity. And what the theorem is saying is that the size of the pie, so how much the company is worth, is irrespective of financial policy or how much debt versus equity they have. And I'm quickly going to jump to this slide. But for example, when you buy a house and you take out a mortgage, you put up some amount of equity value, typically called the down payment. So if you're buying a house for $500K and you put 80% down, you're putting down $400K and taking out a mortgage for $100K. How much is the house worth? The house is still worth $500K. In a different case where maybe you take out a much bigger mortgage and you only put 20% down, you're putting down $100K, taking out a mortgage of $400K, the house is still worth $500K. And so what the theorem kind of says is that this holds true for companies broadly, that no matter how you break the capital stack, they're still worth the same amount. Again, this isn't exactly true. There's information asymmetry where the management knows more than investors. Liabilities, so if you have a ton of debt, it can actually impact the quality of your assets. Taxes also act as a tax shield because interest is tax deductible. Remember, it goes EBIT and then you take away interest and then you pay taxes. So if you have a lot of debt and a lot of interest payment, you can actually pay a lot less in taxes. And firms kind of know this and they prioritize, or I guess the theory is that they prioritize raising capital in three key ways. So the first is those retained earnings. So if Apple generated a net income of 20 billion last year, they retained those 20 billions and use that as their primary source of capital. But let's say Apple really wants to, or let's go with Toyota. Toyota really wants to go conquer the Indian market and build a huge factory in India. And they only had retained earnings of 10 billion. The factory cost 50 billion. They need to suddenly find $40 billion worth of funding. So the next goal is debt. You can issue corporate bonds. You can take out bank loans, and that'll generally satisfy a lot of needs. But sometimes, as a last resort, you can issue new shares. And a lot of companies do this. Maybe they IPO, they access public capital markets, and they go through this process to get a lot more money. And generally, this is the hierarchy of how they would do it. They would first use those internal funds, then raise debt, and then do equity. Yeah.
So building on what Sid just said, it's important to remember that MM theorem holds true in a somewhat perfect world, and the fact we don't live in one tells you where to look. And we here want to emphasize a more nuanced point as to why the curvature of WACC increases so sharply beyond the optimal point. That's the hidden cost of debt, right? So generally speaking, debt instruments return lower, so it's cheaper for the company, but not per se, because they also have lower volatility. As you raise more debt, we live in a world where it begins to impact the quality of your assets. So your cost of equity will also go up. And actually to a point where if you're over leveraged, and we'll talk about what leverage means, your cost of debt will also shoot up. And that's why if you see on this curve, if you go beyond too much to the right, it shoots up a lot. So, yeah.
And firms also, like there's entire rating agencies that are dedicated to rating corporate bonds, and that severely impacts your cost of debt. And we'll go into how that entire structure works. Okay, so again, like we talked about debt versus equity, the pros of debt are again that interest tax shield. And also you don't have to give debt holders the same amount of upside as you would have to give to equity holders. So if you literally just need money to build this factory, you just take out a bank loan, build the factory, and then the bank just gets their interest. But let's say the factory makes you a ton of money, the bank doesn't get any share of that upside. You get to keep it all for yourself. So that's why instead of issuing equity, a lot of firms will choose to take debt. Again, you guys can read this stuff as well, unless there's anything you guys want to add. Oh. Okay, yeah. Last concept, I think, yeah, before we get into valuation. Enterprise versus equity value. So in each of these examples, you put down some sort of down payment, right? You put 400K, 100K, 250K. That notion is your equity value, how much money the company kind of put into itself. On top of that, you have debt. So if you went to go buy this house, you wouldn't just have to buy the 400K or the 100K worth of equity. You'd also have to pay off any people who have a claim to the house. If you only bought the 100K and didn't pay your debt, the bank could come and seize house number 2 because you didn't pay your debt. They have a claim to that asset. So if you want total control of a company, you actually have to purchase it at this amount called the enterprise value. So the formula is essentially the market cap or the equity value. So any company that you Google, for example, NVIDIA probably has around a $3 trillion market cap or something like that. You take that number and you add their net debt. And what net debt is just debt minus cash minus NOA, which is non-operating assets, minus securities investments, minus non-controlling interest, all this kind of random stuff. And I guess the core simple idea is that when you buy this company, let's say Apple suddenly owns like a tiny paint store. You don't really care about that paint store. You're not buying the paint store, you're buying Apple. So when you buy Apple, you can sell the paint store and use it to pay off the debt. And that way, you actually just own the asset you're trying to own. I hope that makes sense. I don't know if this is better.
Another analogy would be, think of enterprise value as the entire pie, the entire pizza, and equity value as how many slices the equity investors get.
Yeah. Okay. Again, just threw a lot. We know this is a lot, and we're not crazy. We know it is. So if you have any questions, feel free to ask them now. And future lectures aren't going to be like this. We generally take a lot more time to explain the nuances of topics, but just because we're trying to cram this all into one lecture, we have to go at this kind of rapid pace. No questions? Okay.
I can take.
Okay.
So remember, one of the core concepts was how much is a company worth? Well, it's the present value of all the cash that it will generate. And here we distinguish free cash flow into two different forms, levered and unlevered. Remember earlier on, we're talking about how many slices each, claim owner gets of the whole pie. And this is basically the same story. The unlevered cash flow is how, the cash going to the entire enterprise, whereas the levered one is the one going to the equity owners. And we have some formulas here, but what you really need to know is you would use unlevered free cash flow or a discounted cash flow analysis or a model, which is definitely going to come up in your investment banking or interviews. But you will use levered free cash flow for, I guess, private equity interviews. So this is very relevant.
All right. I like this. The kind of stuff makes me nauseous. I hate thinking about all of these nuances. I don't know how relevant it is for the job, but I guess you have to know it. Okay. Moving on to valuation. This is essentially asking the question of how much do you pay for a certain company, how much is the company worth, how much should their shares trade at, and you're trying to get some notion of intrinsic value to the company. So what is the company actually worth? So the intuition for multiples-based valuation is a company should be worth similar to what other people have paid for similar companies. So that's why it's relevant companies. It's really easy to do. You can look up the PE ratio of Apple versus Microsoft versus Google and kind of see which one is trading more expensive or more cheaply. But of course, it doesn't capture the idiosyncratic strengths and weaknesses of certain companies. So for example, Apple has a lot more like cross-selling, right? Like if you have an iPhone, you're likely to have a Mac. Whereas if you have a Windows computer, you're probably also going to have an iPhone. So, all these little nuances don't really get captured in just looking at multiples. Then again, it is really simple to do, and it gives you a broad sense of market sentiment. And it's also not functional for thinly traded and liquid stocks that don't move that much. And a lot of times a niche stock won't exactly have great comparables. So the first step in doing this is to identify which companies you're actually compared to. So you can look at all these factors, like what are their market segments? Do they operate in the same country? For example, you probably couldn't compare Apple with Huawei because they have two different end markets. What are their distribution channels? What are their competitive advantages? What is their credit profile? Is one levered? Is one not levered? Like all of these different factors. For example, Coca-Cola, you would probably be comparing it to Pepsi. They operate in essentially the same markets, are essentially equal competitors, and a couple of other Dr. Pepper, Snapple, blah, 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 blah. Okay, then you would go onto Bloomberg or Google or Yahoo Finance, compile all of your financial information, sales, EBITDA, EBIT, earnings, their price, the market cap, total enterprise value, all these things are readily available on Bloomberg. You don't actually have to do any of this yourself. And then you would compare them. So you would either choose to include all of them, you would make some sort of statistical distribution and take out outliers, maybe just look at the 25th and 75th percentile, but essentially you're trying to get equal comparison. And one little nuance here is that different companies have different financial years. So as an example, maybe Apple has their financial year ending in August or September, whereas Microsoft ends in December, and maybe there's a big buying spree in December as people buy gifts for Christmas. So you have to recalendarize their earnings. And this is a little graphic that kind of shows you how to do that. And it's just a formula. You can do it in Excel very simply and probably not incredibly relevant for your interviews. Okay, types of multiples. So the ones you've all heard of, PE, price to earnings ratio. It's the stock price over earnings per share. Alternatively, if you just multiply the top and bottom by the number of shares, you would get to the market cap or the equity value over net income. And this is essentially for every dollar of net income, how much equity value is there in the company. Typical PE ratios can range from like 12 to 20, or no, 12 to like 50, I guess. There's a pretty broad range. Some companies trade at ridiculous PE multiples, like I think CrowdStrike before their Windows crash was trading at like 350 or like 400 PE ratio. So again, this is some notion of value, and typical value investors will only really look at companies that are like under a PE ratio. Something like that. Second is like price to book. So if you are, for example, an infrastructure, a utility company, you have a ton of really hard physical assets that have an objective book value. You can take the book value of equity. Sorry, now let's price to assets. Okay, fine. Yeah, we gotta speed up. So you can look at all these things. The last one I want to mention is EBITDA. This is when you're looking for buyouts. They will typically quote like an EBITDA multiple range of like what the company is actually worth. So 5 to 7x, and we'll go into this in a bit. And you can also make your own multiples. You can really make whatever you want. For example, if you are a oil and gas company, you would do EBITDA X, which is EBITDA earnings before interest, tax, depreciation, amortization, and exploration expense. So for example, you have to pay for a bunch of Arctic cruisers to go and look for oil. Maybe you expense that, or you look at the multiples before that, because that's a more clear picture of the operational efficiencies of the company. So these are different EV to EBITDA multiples by sector over time. Again, it depends widely on which sector you're in. For example, industrials are at 13, whereas consumer staples are at 17. So that's a lot of money. We're talking about billions of dollars of EBITDA, 4x multiples, $4 billion difference between those two. And this is an example. This is from a TSIG pitch of different companies and how you look at that, looking at your max, your min, your median, comparing, selecting which companies you actually want to look at, which ones you would include. It's purely subjective. And the S&P 500, if you take the average PE ratio by weighting, you can kind of see the trend of like how overvalued are companies, how undervalued are companies. Again, it's not an extremely precise metric. Okay. Again, like we talked about, any company at its core, at the simplest, abstractest level, is just a sum of future cash flows. So you have a cash flow in period 1, you can discount it, and a cash flow in period n, you can discount it. So the step 1 of building a DCF is to actually predict out those cash flows. So what does their revenue look like going into the future? What is their EBIT? What is their D&A? How much CapEx do they need to spend to get this revenue? You kind of go about 5 to 10 years, and the goal is to get to a company in steady state. What does steady state mean? It means, for example,
That's not going to change.
Yes.
Models.
Yeah.
Steady.
So there's no big growth that's going to change. Like the models kind of, they're at steady state, at equilibrium. So think of like a utility company. There's no really big changes that are going to happen in that company's future. Whereas if you're investing in Facebook in like 2008, they were definitely not in steady state. They were in an extreme growth phase. So that's a lot harder for a DCF to capture. This is a pretty basic model, also from TSIG. And you can see how you get down to unlevered free cash flow. And then the last line, present value of UFCF, is actually doing that discount rate calculation. And in DCFs, you would discount something called the weighted average cost of capital, which we already went over. So in this formula, that R would actually be your WACC in each of those periods. Okay, then obviously at the end of this forecast period, after 6 years, the company isn't worth $0, it's worth some amount of money. There's 2 approaches to kind of capture that terminal value. The first is the EBITDA multiple. So like we talked about, there's EV to EBITDA multiples for companies. And if you go back to that comp set, you can see that the EBITDA multiple for comparable companies to this one, Siemens Energy, we're trading at around 18x EV to EBITDA. So you take the EBITDA in the terminal year, multiply by the multiple, gets to the terminal value in 2029, and then discount that value back to today, sum that up, do that thing we talked about from going from enterprise value to equity value. So essentially subtracting out net debt and dividing by the share price, and you get to an actual tangible value of how much those shares should be worth today. The second way of getting the terminal value is doing a long-term growth rate. So essentially you say, okay, this company is going to grow at 2% per year, 3% per year. Generally, this number isn't that big because it's usually the growth rate of an economy, which is, again, around 2%. You do these formulas and, again, get to the same implied share price. So yeah, again, the 2 core assumptions here are that EBITDA multiple, that long-term growth rate, and doing that enterprise value to equity value transfer. The last step is you have to sensitize your model. So one of the biggest, and we'll go into the caveats of the DCF, but your inputs matter a lot. Namely, if we go back to this formula, the R, the discount rate, which is in this case your WACC, that matters a lot, and those 2 long-term growth rates, EBITDA multiples. And you can see when you build this out in Excel that the range of values that we calculate for the share price in the bottom right, if WACC went up to 11% and the EBITDA multiple fell to 14x, the worst case was like a $30 per share, and I think it was currently trading at $28. So we said, it's probably a good investment. And when you put it all together, you get this thing called a football field, which looks pretty nice, and it tells you, based on EV to EBITDA multiples, based on price to earnings multiples, based on your DCF, and all these other random multiples, what is the likely set of outcomes for this stock, and you can kind of make an investment decision based off of that. Okay, a lot of caveats to DCF. For one, even if so company A is trading at $20 per share, you think it's worth $50 per share, the market somehow needs to incorporate that information, and your company needs to have a catalyst to actually get it to that notion of intrinsic value that you calculated. And markets are incredibly irrational; they're not efficient. So you can even get to negative enterprise values and all these weird things that happen in markets. So again, you need a catalyst to kind of get there. DCFs are very, very sensitive to your inputs. Does anyone remember what we talked about last week? about sell side equity research and how, there might be a conflict of interest there.
We talked about how in addition to sort of offering their analysis, these companies are offering finance products to companies, so they're incentivized to like give buy ratings.
Exactly. So I'll really quickly do that because I know there's a lot of new faces here. But if Microsoft is going to Goldman Sachs, and Goldman Sachs wants Microsoft to be a client in their investment bank, they might have Goldman Sachs's equity research team give Microsoft a buy rating, probably helps them in some way. But again, they use DCFs. You can really make a DCF say whatever you want. I can change my WACC to 2%, and the company's worth suddenly a ton, like a lot more. So what people think is if you add enough detail, you kind of get over all these things that you project at the asset level. Typically, what people say is that detailed models can give you false overconfidence. The real world is really random, really stochastic. You have no way of predicting what happens in the future. COVID, for example, was a big thing. No one predicted it. No DCF kind of took that into account. So there's a lot of a really wide distribution of set of outcomes, and your DCF can't really do it. If you go on forums and you ask, I guess this guy's a certified hedge fund professional. He says that valuation is less important than understanding what would cause that delta that I talked about, where something has to close to get to your notion of value. He says that that's obviously more important. And I think at TSIG, that's something that we've also had as being important. Okay, really quick. Any questions? We're running out of time. But yeah, any questions?
So the three concepts we covered so far, accounting, corporate finance, and valuation, that's probably 80%, 85% of your IB technical interviews. This is like the last 15%. So even though we don't have much time, most of the more important stuff have already been covered. But again, if you want to pass your technical interviews, you kind of need to answer all your questions. So yeah, those are quite important. Go again. So M&A. So why M&A? So on the left, you see Microsoft, and on the right, you see some companies that want to buy. There are many reasons for why a company might want to buy another. They want to eliminate competition, expand their business, new geographies, or just get some IP. And on the same token, there's quite a few reasons as well for why you want to sell a company. You want the money, you're under financial pressure to sell, or you maybe just want to exit the market. You don't think that particular segment is competitive for you and you want to leave. So there's a lot of reasons why M&A happens. One of the main reasons why M&A happens is synergies, especially on the acquirer side. Now, what synergies is basically the assumption that if you combine two companies, they're worth more than the sum of their parts separately. And there are three main synergies to look at. You have revenue, cost, and financial. Revenue synergies are pretty self-explanatory. So if company A has 100 in revenue and company B has 50, if you combine it, it's an expectation that the combined revenue will not be 150, but something more than 150. Because by combining the two companies, you can start selling products from one company to the other or vice versa, or doing a lot of this other stuff here. On the other hand, cost synergy is the same thing, but in the reverse. If a company A has 50 in cost and company B has 50 in cost, this doesn't mean that the combined company has 100 in cost. It might have 70, 60, or even less, because by combining two companies, you can consolidate a lot of different things. You can file a lot of different people, cut costs, things like that. And finally, financial synergies. This is just like added benefits of M&A, more on the financial side. It's better to be diverse, lower cost of capital, like more nuanced things. But the two things on the left are most important. So quick briefing on different M&A strategies. There's like typically three different types. You have your horizontal M&A. That's your typical M&A, same industry, same stage of the market. Walt Disney, 21st Century Fox, or like Facebook and Instagram. Lots of cost and revenue synergies. This is the most typical kind. But you also have vertical M&A. So this is when two companies are in the same industry, but are at different stages of the supply chain. So maybe a distributor buys a supplier or vice versa. An example is Amazon and Whole Foods. And this is mostly for cost synergies, though there are some revenue synergies as well. And finally, you just have your, completely random M&A, your conglomeration. This is mostly financial synergies from diversification, but of course, there's also some revenue ones if you want to expand a little. But yeah, these are some examples of that. Most important thing about M&A, especially that you'll be asking in your interview, is how do you finance an M&A transaction? So there's three main ways you can do that. You can use the cash on your balance sheet that you have access to. You can raise debt, or you can use your stock to promise your stock to the company you're trying to buy. So excess cash is the cheapest form of financing. This is followed by debt, which is slightly more expensive because of the interest rate. And finally, stock is the most expensive. This is because if you give away stock, you're kind of diluting your own share in the combined company. So this can not be good. There's explanations here for why you might want to do one over the other. Somebody gave feedback in the last class that they wanted more like words on the slide. So especially with this being on the end, I kind of thought that maybe we might not have time. So if I'm just gonna skip past this, but please we'll send you the slides and you'll be able to read up on this. And yeah, so once you have this M&A, as people said before, you have to determine the right price. This is all your valuation metrics, and they give a range, and this kind of influences what the cost of an M&A would be. But more importantly than price is should the merger even happen? The main way that investors look at whether or not a merger should happen is through something called your earnings per share. This is basically how many dollars of profit one share in that company kind of has ownership for, and it's just net income divided minus preferred dividends. You don't really know what that is, but pretty much just net income over the number of shares, in the business. And in an M&A, you really want your deal to be accretive. That means that the earnings per share of the combined company is more than the earnings per share of the standalone. If the opposite is true, it's called dilutive. You really want accretive M&A deals. And the way you determine whether or not EPS is accretive or dilutive is something called a merger model. This is a lot more advanced than the DCF and the other stuff we did before. So it's beyond the scope of the class. The good thing is that you don't need to know this for your interviews, but it's a good thing to know how to model.
Long story short, you build two models instead of one, and you model out what the combined business will look like.
Yeah. But on a more intuitive basis, so this is what you call accretion dilution analysis.
It's not scary. I'm just wondering.
On the very most right is the EPS by itself, and the one next to it on the yellow is a combined company. So you see the yellow is higher than the blue, that means it's accretive, it's better. And the way these are kind of what influences whether or not it'll be higher or lower. I broke them down to 5 main things. So on the left, you have projected earnings. If those two things are higher, more likely the yellow is also going to be higher, so you want that up. Next is synergies. If synergies are more, that yellow thing is even higher, better. Now you want transaction effects to not be as high, because that kind of deducts from the earnings per share. And then also form of financing and purchase price. Of course, if your purchase price is more expensive, you'll either have more interest payments, more deduction, or more shares, meaning when you divide pro forma net income by the number of shares, your earnings per share is less. And of course, form of financing would determine how much debt, how much equity you use, which one will take away more from the earnings per share. Yeah, this is in interview questions, you'll be given a scenario and asked, is this deal accretive or dilutive? This is how you do it, quick and dirty. It's on the slide, so I'll just skip it for now. And this is probably the hardest question you'll get. It's quite a lot. Actually, it's not that much. You take all the scenario stuff, all the info, you get all the parameters, and you just plug it into that formula at the bottom. Yeah. And you'll get it.
And just as a quick note, ChatGPT can't solve it. I was questioning Jason's work and I threw it into ChatGPT 4.0, 01. Neither of them got the right answer. So you do actually have to kind of know this stuff, even if your interviews are virtual. And you can't just not that you should do that.
Yeah. Okay. Next, your LBO. Now, I just want to get to the main. I'll be very quick. The main premise of an LBO is when you buy a company, you don't just use your cash or equity. You buy it with debt. And why do you want to buy it with debt? Well, we have an example at the bottom here. Let's say you buy a company worth $100. Okay, on the left and the right. On the left, you buy it fully using your own cash equity. And let's say in a year, it's now worth 110. If you sell it, you only make a 10% gain on your $100. However, if you buy it 80% with debt, let's say there's no interest or whatever, you don't pay down anything, that same company increases from 100 to 110. When you sell it, your portion after you pay back to debt investors is 30 from 20. So that's a 50%. So this is why LBOs happen. Now, LBOs are done by private equity firms. This is what private equity firms look for when identifying a good LBO candidate. The most important thing is they want recurrent revenue streams that are stable. This is because if you're buying a company with a lot of debt, you have a lot of interest payments. So you don't want a company to make a lot of money in 1 year and then little money next year and then a lot of money. And you don't want this variation because your interest payments are the same. So you want to at the very least be able to make those interest payments every year. So you want stable cash flows and all these other things. Okay, very quickly, there's some how do you make money in LBO. You either sell the business, you list it on the stock market, you do what's called a dividend recap. This is when you purchase extra debt to pay yourself a special dividend. And this slightly more complicated one, the below par debt repurchase. So technically, a private equity firm can buy the debt of its portfolio companies. And sometimes in markets which are very irrational, like in 2008 and 2020, you'll actually find that the value of the debt is trading a lot less than what it intrinsically should be. So the company can buy that debt, and then when it goes back up, they can sell it again. Again, LBO model, beyond the scope of this class, you don't need to know this for technicals, but again,
sometimes they might ask you to do a paper LBO, which is really, really simple. It's not as complicated as a merger model. It's just like a DCF with like slight twists where you have to use your cash, the free cash flow that we generated in the DCF. Some portion of that actually has to go to pay back interest, which is leverage free cash flow versus unlevered free cash flow. Again, you can find resources on how to do a paper LBO online.
I think the last two slides, yeah. So LBO return drivers. So there are three main ways you make money doing an LBO. One is you grow your EBITDA. This means that bottom line profitability after the exit period, you have more than you started with. The second portion is to deleverage. That means is you use the free cash flow that the business generates to pay down the debt, so that when you exit, you have to pay less debt and you own more. And then the final one is this thing called multiple expansion. This is basically where, let's say you buy a company at a PE ratio of 10. That means for every dollar of earnings, you pay $10. But if you exit at a PE of 12, that means the investors are paying you $12 for every dollar of profit that you generate as a business. So that's good. And you typically put this in a graph so you can either kind of see what the main drivers are to your thing. This is this. And then finally, the last slide, how do you quantify performance? There are two main ways to do it. You want to do this?
No, you do.
Is just internal rate of return and the multiple on invested capital. Internal rate of return is basically, that discount rate, that WACC, that whatever way you discount the future cash flow to the present. The IRR is basically what that has to be for the present value of the company to be zero. On the other hand, the multiple invested capital is just you're dividing how much you exited with divided by how much you put in. And the reason that we need both of them, you need both, is because the internal rate of return takes into account the time value of money. The multiple invested capital doesn't. However, on the drawback, the IRR is kind of like finicky, especially if you move payments forward and back. So you kind of need.
And really quick, the rule of 72, and I guess the other ones is if you took 72 and you said like in 10 years, what IRR would I need to double my money? 72 divided by 10 is 7.2. You can do the same thing for 144, 14.4% IRR will let you quadruple your money. Just useful rules of thumb. Last two things, additional resources. Again, I think the biggest mistake that we make here at Princeton is we think that because we go to Princeton, we're guaranteed a job at Goldman Sachs. The answer is no, you are really, really, really not. Somehow, like we all, I guess, have this perception that, oh, I got into Princeton, I'll be chilling. No, you really aren't. You have to grind. You have to be better than everyone else. So hopefully this gives you an idea of what all you guys don't know, so you know how much is out there for you guys to study. It doesn't take that long, and it's not as complicated as we probably made it sound. It is pretty simple. I linked some resources here. If you're a frosh, don't bother learning this right now. Grind it out next summer. I mean, it doesn't hurt to start early. But I'd say no one's going to hold your hand through this process. You have to take the initiative and do it yourself, which, I mean, by coming here, you guys all are. Last thing, Tiger Investments is holding a same thing as this, 8:30 to 9:30. I believe it's in Robertson as well. Info session or education session. They cover everything we went through in this lecture over 8 weeks. So literally, maybe a bit less than what we went over, but generally everything you needed for technicals. We know the people running it, they're really smart people. They've also put a lot of time into their slides. If you have the time, I'd highly recommend attending. Last thing, if we provided any value to you guys at all, please fill us out. It helps us get more funding so that we can have more free pizza. And you'll have an option to give us feedback there. Please give us the feedback. If we didn't already show it, we do read it all. And we incorporate it into the future ones. And if you fill this out, you'll also get access to the slides. Next week, we will not be having a meeting. It's midterm week. And then we won't come back until after fall break, which will have one of our favorite lectures, I think, which is what is a hedge fund. And we'll actually go into what equity strategies look like. How do you even define a hedge fund? why do multi-managers such as Citadel and Millennium even exist? What is a Tiger Cub? And all of these things that you should probably know before you go into the finance field.
And yeah, it will be a lot slower pace than this.
Yes.
This is not indicative of our future lectures,
Yeah.
by the way, the pace at which we went through this.
This is going to be the most boring lecture we've had, the least interesting, and also we don't talk this fast usually. And somehow we got through 76 slides in
An hour.
an hour, which was our goal. So yes.
Rob more pizzas on the way out.